Commit to Wealth Nation, welcome to the Commit to Wealth podcast. I'm your host, Juan Vargas. Today on the show, we have Jeremy Roll. Jeremy got his start in real estate investing and business back in 2002, and in 2007, he became a full-time investor. He's currently an investor in over 70 deals in businesses worth over $1 billion in asset value. He's the founder of Roll Investment Group, and he's the founder of For Investors by Investors, a nonprofit organization that is now the largest group of public real estate investor meetings in California with over 27,000 members. Jeremy, welcome to the show.
Great. Thank you so much for having me on. I really appreciate it.
Hey, no, it's an honor to have you on. And so, yes, you have definitely been on a few podcasts, and it's a pleasure to really have you on because you bring a ton of value. You bring a lot of information, a lot of experience. And so I really want to tap into your brain and your knowledge. So let's get into that. But before we get there, tell us a little bit about who is Jeremy Roll.
Sure. Yeah. So thanks again for having me on. So I would say that the best way to describe me is I'm kind of a full-time passive cash flow investor. The cash flow actually got me out of the corporate world in 2007. And I started investing in real estate in 2002. I started off in commercial real estate, always as a passive investor. So a limited partner, mostly in syndications. And it really started as a result of me just being fed up with the stock market after the dot-com crash. And for me, the whole passive cash flow focus is kind of on the lower risk side. And that I look for more predictable cash flow. And I really wanted to get out of the stock market for the lack of predictability, like not knowing where my retirement account would be in 10, 20, 30 years. That bothered me the most. I look for more stabilized properties with more predictable cash flow. And, generally I want to go to sleep tonight, wake up tomorrow, and not much has changed because I live off the cash flow. So I'm really dependent on the cash flow and it being predictable. Mm-hmm. So that's kind of it in a nutshell as far as full focus. And as you mentioned, I'm co-founder of For Investors by Investors, which is a nonprofit organization for networking and learning for public meetings for investors, and also president of Roll Investment Group. And I'm also originally from Montreal, Canada. I lived there about half my life. I'm now in LA. I have an MBA from the Wharton School, which is over at University of Pennsylvania in Philadelphia. I'm a licensed California real estate broker for investing purposes only. I've never used it for anything but investing purposes. I like diversification. That's like my big thing. I'm hyper diversified. So always looking for more opportunities to network with anybody. I'm very fortunate that the cash flow is just I don't want to sound like an infomercial, but the cash flow completely changed my life from the corporate world. I mean, my last two jobs were like Toyota headquarters and Disney headquarters, just to give you an idea. Mm-hmm. So, and I've been very fortunate to be out of the corporate world since 2007.
Gotcha. Well, yeah, that is very good for sure. So Jeremy, let's get into this. Tell us, for those of the people who are listening, we do. Well, I would say I'm not going to assume here, but I would say the majority of the people do know what passive investing is. But let's get into the details of it. What really is passive investing in your terms, in your definition?
Yeah. Right. So I have my own definition, and it's not like I don't know if there's a dictionary definition, but for me personally, passive investing means that you give up control. So I talk to some people who may own, let's say, a single family home or a few, and they consider themselves passive, but I don't consider that passive because they actually own the property. That means they actually either have to hire or fire a property manager. If a toilet has to be changed, they get a call asking if they want to and how much it is and that type of thing. They can, sell the property, refinance it, pay down the mortgage. They can do whatever they want. They have full control over the property. In the way that I invest, I give up control. And I like to tell people that I give up control in exchange for diversification. So what I mean by that is I invest, I'm a small piece of a larger deal, mostly commercial real estate, but not all. And in doing so, I have a very, very small vote. So I pretty much give up control. It's pretty much a meaningless vote. Might be less than 1% or 1% or whatever it is, even if it's a few percentage points. And but in exchange for that, I get to diversify much more than an active investor would be able to, because they may be putting a larger down payment down on a property. They may be limited by the amount of credit they can get across a certain number of properties. They may not have experience across a whole bunch of different asset classes to be able to go into those. And so there's a lot of reasons why I can get a lot more diversification than an active investor, but I definitely have more risk because I give it control to somebody else. And that means that there's always going to be a fraud or mismanagement risk, and other types of what I call 1% risks that are always there that you can't get rid of as a passive investor.
Got it. So you're going to give up control. And so somebody else is going to operate the property. You get to diversify across many different markets, across many different states, but not only geographically, but also asset classes. So you get to diversify even further, which that right there reduces your risk. So on the show, and as you see on like sites like Bigger Pockets, you see most people out there want to be uh, active. They want to be general partners. They want to be the guys bringing down the deals, finding the deals, taking them down, overseeing the operations, doing those kind of things. But do they really? And so that's one of the questions that I wanted to ask you is, there's advantages to each, but I want to see, why is it like is a must for you to be a passive investor versus being active? And I know you've already covered some of those things, but give us some more, I guess, details on that.
Sure, yeah. So what happened with me is that when I first started investing in 2002, I was very busy. I was a middle-level manager at Disney headquarters. It was crazy busy. So I had no time to do this actively to begin with. And so I started on the passive path. And what I discovered is that the passive path just ended up being a very good fit for me personality-wise. First thing I would say is that if someone's trying to figure out where to start, active versus passive often comes down to personality fit. Some people do not like giving up control, and passive is not the good solution for them, regardless of whether they're busy or not busy in their job or whatever it is. That's number one. Number two is I love the concept of diversification because I like peace of mind. And so what I mean by that is that I love having as many eggs as many baskets as possible so that when I go to sleep tonight and wake up tomorrow, if something bad happens at one property or even with one operator or even in one geography or even in one type of asset class, like in enclosed large malls, which is having their challenges, it's not going to have a major impact on me. Now, it takes a long time to get really hyper diversified. Once you're there, it's a great place to be. So it takes a lot of work. But for me, the diversification aspect is probably the key advantage. And I kind of tend to downplay the idea that like I cannot go and buy a $25 million commercial building right now myself with my credit, or at least I don't know if I can. I'm assuming I can't, but I don't know. And frankly, I couldn't buy more than a few of them, that's for sure. And so, I'm able to leverage other people's time, efforts, work, credit, and probably most important, experience across the asset class. That's another thing, right? If I decide I want to go buy a mobile home park tomorrow actively and I know nothing about it, I've got to go learn about it. I may buy one or two or three and kind of learn the hard way through experience. Whereas as a passive investor, I get to filter out the operators who have that experience, who've actually already learned the hard way from their own time and money in the past. And I get to kind of help reduce my risk. And so, I'm biased because I know that passive investing is the right fit for me, but it's not the right fit for everybody. But there are a lot of advantages on the passive side if it's the right fit for you and if you like the concept.
Very good points. Very good points. So as a general partner or as somebody taking down the deals, one of the things that I guess as a passive, and correct me if I'm wrong, is that they're not that they don't diversify too much, right? Because then it increases their risk, and if they're all over the place, then what happens to your one investment that you're involved with, right? So they're dabbling into the stores, they're dabbling into triple net leases, and over here and over there. So as an active guy, you can't be as that diverse as you can, on the passive side. So. Is that correct? Is that a true statement or a fair statement, I should say?
Well, I would say that you could probably choose to be very diversified, maybe not across a lot of properties, but across a lot of asset classes with a few properties in each if you want to scale up. But what I would say is that personally, and again, I'm not an investment advisor or financial advisor. I should have said this at the beginning. So anything I'm
disclosure
investor. But I will say that, whenever I find a fund, for example, that I can invest in, I see this sometimes like, office, industrial, apartments, and self-storage. Let's say it's those four, because it does exist. I won't consider it. In fact, I prefer to have an operator who focuses on one thing that they know really, really well. If it's two, I could probably still deal with that, as long as they built up that second division, maybe with a different set of employees with a different set of experience in that asset class, or maybe they're gotten so far along, they've got years of experience in both asset classes by now. But I agree with you. If I'm going to make a bet on someone who's focused on operating something on my behalf as an investor, I like them to be an expert in that one asset class, or two at the most, I would say. I get very uncomfortable with multiple asset classes with the same operator. What it tells me is that either they're scattered or they may be okay at operating each individual thing, but they probably won't be as good as they could have been had they just focused on one.
Yeah,
So
and it could also mean that they're maybe unsure of their operations or unsure of what their plan is, their goals are, So, that's just unnecessary risk, or it can be unnecessary risk, depending on the operator, because there are a lot of good operators out there that can take on multiple projects, but you don't find that so much. So let's kind of switch over to your markets. What markets are you, I guess, involved in, geographically, and why do you choose those markets?
So what I like to tell people is that I'll invest anywhere that makes sense. And what I mean by that really is that I like to look for a growing population, a really diversified economic base in terms of employers,
Mm-hmm.
and also an area you can see that's actually been thriving economically for a while and is projected to continue to thrive. Because I've seen enough deals over the years now that I've actually seen both sides. I've seen areas that are either declining economically or having a population outflux. And whereas really good example, a lot of people can relate to right now, the southern states, Texas, Florida, the Sun Belt, they're poised to gain a lot of population growth from retirees and even non-retirees in the coming years. And so looking at that over the next 10 years, I would be more prone to look at a southern state as opposed to a state that's actually having a negative population increase or decrease each year going forward, because you just don't know what demand's going to look like. And again, it goes back to me looking for that predictability and that stability. That's the way that I invest, and that's why I look at those types of markets. But I'm currently invested in across many different states. What I've learned also is that, I shouldn't say every state, but most states have areas that are still doing really well economically, very high demand as far as population growth, and therefore there's always places that make sense in every state. There's plenty of places that don't make sense in every state too, so you've got to be careful with that. And by the way, when I invest geographically, it's not just a question of economics and population growth. It's also weather and other factors that could cause a problem. So hurricanes, tornadoes, earthquakes, frozen pipes in the north for mobile home parks, for example. Also in the north, if you know this for apartments, if you're investing in a very cold climate and some of the common areas that cost is not shared with the tenants, that could become very expensive,
Mm-hmm.
especially if you've got a spike in natural gas prices one year, and that's all on you, for example, or heating oil or whatever it is. So there's a lot of things to consider for geographically. It's not just necessarily the economics and the population, but those are probably the first two key ones.
Gotcha. Okay. So you like to diversify across many states, across many assets. Let's talk about the kind of returns that you are looking for, the kind of splits that you want to see. What is too aggressive or too expensive in your eyes? And, what do you like to see? What's your range?
Sure. Yeah. Okay, well, let's talk about splits and stuff first. And preferred returns. So whenever I invest, because I'm a cash flow investor and I focus on stable properties, I'm looking for a minimum preferred return. And that preferred return is typically going to be 8% or better. Anything under 8%, and I typically will not invest in. And keep in mind, even though I live in Los Angeles, I invest pretty much exclusively outside of California for higher cap rates and therefore higher cash flows. So I can find those 8% preferred returns or higher out of state very easily. I would say is that on the splits, I find that anything between a 50-50 and an 80-20 is fair.
Okay. So Jeremy, what do you look for in a split? Whenever you're looking at different opportunities, what do you see as a good split, and what do you see as something that you don't want to be a part of?
Yeah, sure. So now what I would say is that so a couple of things. First is that I'm a cash flow investor. So that means I'm typically going to look for a preferred return. And I typically invest outside of California for higher cap rates and higher cash flow. So normally I can find an 8% preferred return or higher. If it's under 8, I just probably won't invest in it at all. So that's my minimum. And anything 8 or over, I think, is reasonable. So it's not like I have to find 9 or 10. I mean, 8 is very common in terms of what I find, and it's totally fine. On a split perspective, so a couple of things. First is that I don't invest in heavy value add, but I would just kind of give you the range of what I typically see, which is, to me, a normal range is anything between 80-20 and 50-50. And what I find is that there's two factors that kind of go into like what I consider fair as to where it lands in that range, depending on an opportunity. One is the experience level of the operator. So a more experienced operator could potentially command a little bit more of the profit in exchange for that experience. And usually you even have a bigger organization to like manage everything. Two is the amount of work that an operator has to do. So to me, the operator deserves more of a split if they have a lot more work to do, and deserves less of a split if they have less work to do. So you kind of factor those two things in. Typically, I see between an 80-20 and a 50-50 split. On the less value add side, in terms of what I invest in, depending on the size of the property too, if it's a very small property, the operator probably needs a little bit more of the split to make sense of actually going into the deal with all the work they have to do just from an absolute dollar perspective. But typically, the most common splits I see are between 60-40 and 80-20 in terms of what I invest in.
Okay, so and even those 80-20 splits that you're doing or that you're looking at, those have an 8% preferred return or something that you would want. So 80-20 and 8% preferred return.
Yeah, that does exist. I would say it's definitely more rare than finding 60-40 to 75-25. But it's out there, but it's definitely more rare. And to be honest with you, like I tend to avoid investing with someone like on their first or second deal, just me personally. So I don't see them as much because I think those are going to come up with brand new people, for example.
Gotcha. Okay, well that makes a lot of sense, and that clarifies some things. So for those of you guys that don't know what that is, the splits that he's talking about. So the general partners, the guys that put the deals together, they get their piece, and that's generally anywhere from 20% to 40%, really, on most deals. And then the partnership, the limited partners, they'll get the bigger chunk, the 60%, 80%, if you will. So. That's what he means by the actual splits. Okay, so what else do you look for in a sponsor? Besides the experience, the track record, besides the geographical areas, what else do you look for in a specific sponsor that will allow you or make you want to invest with them?
Yeah, sure, absolutely. And I just want to add one more thing to our previous conversation. If anybody's out there and you're kind of new and you're not sure what splits to look for, strongly recommend you stay away from anything that is below 50-50. Anything where you have less than 50%, it does come up. I see at least once a year. And whenever I see it, I'm just like, oh man, what that tells you is that, in my opinion, it tells you that the operator is just trying to get as much as they can. And I'm not necessarily trying to make it a win-win situation. And that tells you something about their personality too, which is very important to know. But if, as far as where I draw the line and walk away, I won't look at anything that's below a 50-50 split unless it's I don't think I ever have, and would have to be a very odd situation. So going back to answer your question. So I think that the number one thing I could say I look for, aside from the things we've already talked about, is an operator who is looking to underpromise and overdeliver by using conservative assumptions. A conservative person trying to set the right expectation for investors, not trying to make the numbers necessarily look as good as they can, not assuming the highest possible exit price in 5 or 10 years, not assuming that rents are going to increase, maybe even as much as they think they are, but just setting conservative expectations so they can hit those numbers for investors. And they're doing it to build long-term relationships with investors to kind of either meet or exceed their projections. Because I do see all the time people using more aggressive numbers on either rent increases, expense ratios, or expansion inflation, assumed exit pricing at the end with the cap rates and everything else. And those may look really good to investors, but often they're using either unrealistic assumptions or just very optimistic assumptions. They're making the numbers look really good to attract investors, and that's not the kind of operator I'm looking for. I want someone who's got the more conservative personality and looking to build the longer-term relationships with investors. Frankly, all of the time when I see people putting those deals that look really good together for the numbers, they're just trying to find investors today. They're not worried about whether those investors are going to be repeat investors, going to go on to the next one next time if they have to. So that's a very important thing to look out for beyond everything we've already talked about.
Very good point. Yeah, you got to be conservative, especially in this part of the market cycle. If you're coming across any deals, and I'm speaking from a passive investor standpoint because I myself, have also invested in deals passively. So I'm not just, taking down deals or looking for deals as an operator, but I've also invested passively. And so I understand completely what he's saying. And you want these deals to be conservative. At the same time, it's got to be a win-win for everybody, and like he said, if it's less than a 50-50 split or they're getting more of the equity, then it just shows that they're being selfish. And it's not a win-win to where, the investor makes money, then the operator makes money. It's more about I make money, and if you make money, good. If you don't, then you don't. But it shouldn't be like that. So very good point.
I want to think all that. So often what happens is that when you see someone who's actually taking more than 50-50, the thought process, from what I've seen, is that they're reverse engineering into a return that I think investors will be okay with. But the problem with that is that if they're finding a deal at a specific price that is such a good return, then almost always there's a certain increased risk associated with it and commensurate with the actual return.
Mm-hmm.
And so if they're deciding the return should be lower for investors, because investors will probably be okay with the lower return, as an investor, you're not necessarily getting the return you should be getting for the level of risk involved based on how they're buying it. Obviously, there are exceptions, but that's the mentality, just to like better explain typically when someone's doing that. They're just trying to like back into return and take everything else for themselves.
Yeah, that's another great point, man. You're just dropping bombs like crazy over here. So that's good. That's good. So, let's get into the next thing. When you are going back to the properties, what do you like to see on? And I know you're diversified, across many different asset types. So, what do you like to see on the property level? What don't you like to see?
It's going to depend on the asset class. First thing I'll say is that I invest for diversification. So I always look for tenant diversification.
Mm-hmm.
I have cutoffs for every single asset class. I'll give you some random examples where, like, for multifamily, for example, I usually prefer to be in 100 units or more. Probably wouldn't consider more than at least 75 or more tenants, just because to me that's the total tenant diversification, and diversification is just more peace of mind to me. But in the same vein, like, different asset classes are different. So retail strip center, I might look for 13 tenants or more, minimum 10. In a self-storage property, I prefer over 500 or 800 units, but I'll do 300 or more at the very base. And so each asset class is going to be different in terms of what I really look for at the property level. I tend to invest in a Class C property, typically in an A or B, more commonly B area. Mm-hmm. So the location is going to be important, but again, the importance of the location will differ depending on the asset class. Mm-hmm. Where a mobile home park is located is a very different equation versus, like, if I want to be in a self-storage property where they get half of their sales from drive-by traffic, mm-hmm. or a retail strip center that's got to have a lot of good visibility. An apartment doesn't have to have the same visibility as a retail strip center with the amount of cars driving by every day, as an example. So each asset class is going to be a little bit different, but in general, I focus on Class B assets in an A or B market.
Gotcha. So you get into a deal, the deal closes. What do you like to see? What kind of communication do you like to see after the deal closes and moving forward?
Great question. The number one thing I will say for anyone who's kind of new at this is that communication is what's very important is to get to know the operator up front, so you know what the expectations should be on your part. Mm-hmm. Everybody communicates differently in terms of frequency and, frankly, in terms of detail. And if you could ask for sample quarterly reports, for example, or monthly reports, or however frequent it's going to be from the operator before you invest with them, it's very important to know what to expect so that you don't end up disappointed if the reports aren't what you were hoping for because you didn't check them in advance. So that's very, very important because it really is all over the board. I have a requirement that I require at least quarterly reports in terms of, and that's very common, and quarterly distributions. If it's less frequent than distributions and reports, I probably won't invest in it. Sometimes I find monthly distributions, but that's more rare for sure, and it puts a lot of burden, administrative burden on the operator to the point where I just don't think it's necessarily fair to them, but if they choose to do it, I'll take it. But definitely quarterly reports at minimum for what I require. I personally like to see reports that compare the actuals of the cash flow distributions compared to, and revenues and expenses and everything, compared to the original projections. What I find, though, is that a lot of the operators sometimes tend to like to compare that, we're in 2019. They may show a comparison of Q1 2019 to budget Q1 2019. And there's definitely a fair argument that makes sense too, because what some operators will say, look, you invested in this retail strip center 8 years ago. A couple of tenants have changed. You can't compare the original projections to now because it's not realistic 8 years down the road. And I would say, totally understand. And so they're liking to compare it to budget because they're budgeting for the year. And that's the most realistic projection, is the one that's most recently done, which is the most, the annual one that they're doing. Mm-hmm. The problem with that is, as an investor, as a cash flow investor, sometimes they don't understand is I invest in an asset class for cash flow. So I don't care whether there's a certain tenant there or a different tenant there, right? In the end of the day, if it's producing a cash flow it needs to produce, that's what I really care about. I live off of cash flow. So I like to compare it to the previous cash flow was projected 8 years ago that I'm expecting today, because that's what I invested for. And I had certain minimum cash flow criteria that I was targeting. So I understand the flexibility is needed sometimes, but I personally prefer to see the results in the quarterly reports compared to the original projections as opposed to budget. That's one thing I will say that I see that can change depending on the operator. And again, that's a question of asking the operator up front, how do you report? I'm not saying I won't invest with somebody because they report that. I'm just telling you my personal preferences. I definitely get reports of both types for sure. I like to see, I don't need to see the largest breakout of everything for like 10, 20 pages, but I want to see enough information that I understand what's going on, any potential challenges. I prefer it when an operator updates us more than quarterly if there's a major challenge that comes up, but I don't necessarily expect it. I'm also not okay with getting 5 sentences about the property and a check. You laugh, but it does exist, and,
Wow.
and it's an anomaly, but it does exist, and it's something you want to check on in advance and ask for that quarterly reports in advance so you can see what you're getting yourself into,
So you think it's a good idea for those that want to be passive investors to maybe get a sample of the prior communications? You think that's a good idea?
Yes. Even if they're hesitant to give it to you, just say, look, I understand it could be confidential. Just black out whatever you need to black out, person's name, performance numbers. If you can't share it with me, I just want to understand, even like, send me a template of what you include. Is the kind of first section general high level update, second section's projections versus actuals, third section might be the rent roll, fourth section might be the revenue versus expenses, whatever it is. Just get a good enough idea so that in the end of the day, you don't end up disappointed, or maybe you would have even decided not to invest it because you would have figured there wasn't good enough reporting, but you didn't ask the question and didn't look at the reports.
Got it. Okay, good. So you've done this for quite a while now. I mean, you started in full-time in 2007, full-time, but you started, you're investing in 2002. So I would say that throughout these many years, you may have made a mistake or two, throughout your career. So tell us, what has been the biggest mistake that you have made, and what was the lesson out of that?
The biggest mistake. So I would say that, and this pertained more to like some startup investments I've made, but it still carries over for sure to any passive investment you're making.
Mm-hmm.
I used to invest, if a property looks really good, it's kind of easy to get lost in, oh my God, what an amazing property. I got to make a bet on that deal.
Mm-hmm.
But it's not about making a bet on that deal. It's the same thing with a startup. Great concept. Looks like a great idea. It's about making the bet on the operator and the person. That's the number one thing. And so what I've learned, the probably most important lesson is, the number one most important thing is who you're making a bet on. The number two most important thing is the actual opportunity itself. Of course, the opportunity itself is very, very important, but who you're making a bet on is even more important. And I can give you multiple reasons as to why that is. But that's probably the number one lesson that I've learned, for sure. I definitely tweaked many things I've done. Like I mentioned, reporting, that's one thing you're going to want to ask for at the beginning. I didn't ask for it, and definitely had some interesting scenarios way early on with like not getting the level of reporting that I would have liked. There's been a lot of lessons over the years. One thing I'll say too that's very, very important, I find a lot of passive investors don't do this, is when I invest, I tend to invest in, let's say, average deal is a 10-year term projected. Could be less, but that's a projection. That means that I have to think 10 years ahead as to whether this asset's going to perform well. So to give you an idea, in 2013 is the first year that I started investing for a downturn in this cycle. And right now we're recording this at the beginning of 2019. And it doesn't mean I was only investing for like a recession. I didn't think a recession was coming up a year later. I thought there was going to be a recession in 5 years, which was 2018 at the time, which was wrong. But the point is that I want to make sure anything I was investing at that point was going to do really well during a downturn. And people don't think that far ahead. Right now, I'm just constantly thinking about self-driving cars, robots replacing jobs, artificial intelligence replacing jobs, and just how is that going to change the usage of certain properties? Is office going to be in the same demand in 8 years from now when self-driving cars could take you to a job that's further away with less of an issue? Or even flying, drones potentially Uber may have that could take you to your office building in 2 minutes instead of 30 minutes. Of course, I'm making all this up, but the point is these are the kinds of things you have to think ahead about. The aging population, what's that mean for the asset class you're investing in 10 years from now? Are you investing in assisted living because it's going to have more demand in 10 years from now? Or are you investing in the asset class in the wrong location, in the kind of age-restricted apartment community, but in the wrong location where people are moving out of into a southern, Sun Belt 10 years from now? So I can give you a ton of examples, but thinking far ahead, the onus is really on the operator to kind of think the business plan through, but it's on the investor to try to protect themselves too and to think all these things ahead and to really kind of try to avoid a lot of the pitfalls that could be there. And so those are just some quick examples, but there's definitely been a lot of lessons.
For sure, for sure. Yeah, I'm sure you have learned, not necessarily from your own mistakes, but from others' mistakes as well. So how do you go to, what's your step? If somebody's listening, what is their step to find those good or new investment opportunities? What do they have to do?
Yeah, great question. So, it's the landscape has changed in the past few years for the better in that if you're an accredited investor, which is not a member of a club, it's the actual SEC definition, the requirement as far as either a certain minimum income or net worth that you have, then you can go on to, for example, crowdfunding sites and find opportunities today, right now in your pajamas very quickly. The challenge with the crowdfunding sites is that they're intermediaries, they're middlemen. So in most cases, they'll take certain fees. So the returns will be a little bit lower than finding the opportunities directly. But if you're very busy, that's one good source. In the end of the day, it's all about networking. That's the hardest part of my day is finding opportunities as a passive investor. And networking is how I accomplish that. Even though their opportunities now are allowed to be publicly marketed in certain cases if they're structured a certain way based on some laws that came into effect back in 2012, the vast majority of opportunities are still private. And what that means is that they're not allowed to publicly market them. They're not allowed to publicly discuss them even in a meeting. And so that means you have to network to either find the operators directly or network with other investors who can then introduce you to the operators that may have opportunities right now. So in-person networking is hugely valuable, even though it takes a lot of work. You could do some online networking like on Bigger Pockets, although that could be trickier because sometimes you get people selling stuff to you and operators and stuff. So it's a little bit more grayish, or just anything can come to you. But networking is really, really key. And it is difficult to find passive opportunities. If anybody is an investor, if you want to network, try to exchange opportunities, try to find opportunities, even if you're new, I might be able to help. You're welcome to contact me. We talk about that at the end as far as contact information. But networking is just what I do all day long. I network with other investors. I network with operators. I network at meetings. And I really started all this by going to a lot of in-person meetings.
Yes, and I would add to that Jeremy does have a big network, and he does know a lot of people. So those of you looking to or wanting to get into a deal, then he may be able to introduce some people here or there. So definitely good stuff. So Jeremy, it is time for our Nuggets of Wealth. These are questions that I ask every guest every week, and hopefully they are able to help our audience. So question number one is, what is a good tool, source, or platform that you use almost every single day that can also help others?
Yeah, I would say, well, personally, I use something called Schedule Once, which I think has just turned into something called Once Hub, HUB, one word. I think they may either bought or rebranded. Fantastic scheduling link, like Calendly, same type of idea, where it can automatically sync with your calendar. And if you want to schedule meetings with somebody, they just click on the link and they'll see all your availability. Hugely productive tool. I am just on back-to-back calls all day. That just saves me a ton of time. That's a great tool.
Okay, sweet. What is the top advice or tip that you would give to somebody that's just primarily wanting to be a passive investor? The top advice.
I would say right now to be very careful. If you're not that familiar with real estate and you're new, we're, in my opinion, at the end of a cycle or very close to the end of a cycle. That means prices are very high. That means we could have pricing adjustments going forward. And I like to tell people that real estate is partially about timing, and timing is very important. And I'll give you a very quick example that, you can invest with the best operator in the best building in 2007 had been foreclosed a long time ago. And you can invest in the worst building with the worst operator, even in the worst location, and have made a boatload of money already before the end of the cycle. May have already sold it. Timing is really, really critical. Now is a great time to learn, but it's a very challenging time to find deals that make sense. I personally am sitting mostly on the sideline myself and just only going to stuff that has unique pricing. Otherwise, just waiting for an eventual downturn and a price adjustment. So be very careful if you're new right now. That's my number one piece of advice.
Great advice. Yeah. If you're new and you don't necessarily understand what qualifies, and everybody has different qualifications and criteria, but if you're new, you're definitely have more risk in not knowing what really qualifies as a good deal versus, a mediocre deal, so that's one thing is education. Yeah.
I want to clarify too that I'm making that statement as myself as a passive cash flow kind of low risk investor. People who focus on more value add stuff where they're actually adding a lot of value and they're mitigating some of the risk because they're adding value. There's a lot of situations that could make sense. if you're willing to look at that type of criteria. So everyone's different, to your point. My statement applied mostly to just people who are looking to do, low risk cash flow investing.
Gotcha. Good point. What book are you currently reading?
It's funny. I have read books, but I don't read as many books as other people. I tend to watch more like snippets, podcasts, even YouTube videos. Sometimes a book on tape in a YouTube format I'll listen to sometimes. I'm not reading anything specific right now. I just don't do. I prefer to have it in smaller chunks. What I will say though is that if you're new and you have not read Robert Kiyosaki, Rich Dad Poor Dad, and Cash Flow Quadrant, both of those in that order, I would strongly recommend it. It really could change your entire perspective on investing and even your job and everything else. By the way, those are very quick reads. So
plus one on that. So yeah, I back you up on those. Where do you see your business and your company in the next 5 years?
Yeah, I would say that, for me, my whole mantra at this point is to try to continue to build the cash flow snowball for myself, to get even more diversified, build up more cash flow, just to kind of get more and more cash flow, and so I have more and more peace of mind versus covering my cost of living. And so what I anticipate is that I'm going to be waiting until there's a downturn, and then I'll be pouncing on opportunities when there's a downturn for better cash flow. So that's kind of what I figure that's going to take probably a 2 to 4 year process at this point. So in 5 years, hopefully I'll just kind of spend a couple of years getting back into pretty aggressively into opportunities, continue to increase my cash flow snowball. And I just consider that my mantra going forward is the more cash flow I can build up, the better. So
Gotcha.
That's definitely my focus, and it's going to continue that way.
Sweet. I love it. Good stuff. At the end of your life, how do you want to be remembered?
Good question. At this point, I've been really fortunate as far as the cash flow has just completely changed my life. I am happy to help anybody any way that I can. As I get older, I realize my goal at this point is to help as many people as possible in whatever situation is possible. And so I tend to have a lot of knowledge on the investing side, so I tend to have a lot of calls with new people and everything else just to help. And also, like with For Investors by Investors nonprofit, our goal is to help as many people as possible to network and learn and everything else. And if we achieve that goal, then that's great. That's all that counts. And so that's my primary focus, I think, at this point, is to hopefully be remembered as somebody who helped a lot of people.
I love it. Good job on that. Where can Commit to Wealth Nation go to contact you and find out more about what you're doing and your groups as well?
Yeah, easiest way to contact me is through email, which is jroll, JROLL, at Roll Investments, which is ROLL Investments with an S.com. So jroll at rollinvestments.com. Anyone out there want to network for any reason, if you're a new investor, if you're experienced, if you want to trade notes, if you're an operator and you have opportunities, if you're an investor group and may have opportunities for me to invest in, whatever it is, I'm happy to help anybody any way that I can. So
sounds like a plan. So guys, reach out to him if you have any questions. You want some tips or advice. He is definitely the man. So Jeremy, I really do appreciate your time. I appreciate all the value that you have been able to provide for myself and for my audience. And I wish you continued success.
Yeah, thank you so much for having me on. Really appreciate it. Hopefully whoever was listening to this got some value out of it. So thanks again for having me on.
Yeah, thank you so much.
Thank you.